Picture this. You open your banking app on a Tuesday morning. You see your savings account sitting at, let's say, $4,000, maybe $5,000. And for a second, genuinely, you feel good. You feel responsible. You feel like you're doing the adult thing that nobody taught you how to do. You've been putting money away every paycheck. You haven't blown it on anything stupid. It's just sitting there, growing, slowly, safely. And that feeling is real. You should feel proud of yourself. Saving is hard. Most Americans can't cover a $1,000 emergency without going into debt. So the fact that you've built a cushion, that actually matters. But here's where I need to stop you for a second. Because while your savings account is sitting there making you feel secure, something is quietly happening to that money that almost nobody talks about honestly. It's not dramatic. There's no notification. Your bank isn't going to send you an alert about it. But every single day that money sits in that account earning 0.01% or even 4% in a high yield. There's a version of your future self that's falling further behind the version that actually had the information you're about to hear. So here's the question I want you to sit with for the next 10 minutes. What's the actual difference between saving and investing? And why does that difference determine whether you end up financially stable or financially free? If you're someone who has money in a savings account right now and you've been wondering whether you should be doing something more with it, but you don't know where to start, this video is going to give you the exact framework to make that shift step by step without gambling your financial security to do it. Quick note on who I am and why I'm talking about this. I'm not a financial advisor, and I'm not here to sell you anything. I'm someone who spent years studying personal finance, behavioral economics, and the habits of everyday people who actually build wealth. Not on six-figure salaries, but on normal incomes with real constraints. Everything I share here is based on research, math, and what actually works over time. Okay, let's get into it. Here's something that might make you a little uncomfortable. Saving money, by itself, is not a wealth-building strategy. It's a wealth preservation strategy. And for a lot of people, it's actually a slow financial leak they've mistaken for financial progress. I know that sounds harsh. It might even sound wrong. We've been told our whole lives that saving money is the responsible thing to do. And it is responsible. But responsibility and optimization are not the same thing. And if your goal is to actually build wealth over your lifetime, treating your savings account like a finish line instead of a starting line is one of the most expensive mistakes you can make. Not because you're being reckless, but because you're being too careful. Let me show you what I mean with a number that is going to stick with you. Say you're 28 years old and you have $10,000 sitting in a savings account. A high-yield savings account right now might give you around 4 to 4.5%, which is actually pretty good, historically speaking. But it won't always be that high. The Fed moves rates, banks adjust, and that number will drift. But let's be generous. Let's say you earn 4% consistently for the next 30 years. By the time you're 58, that $10,000 becomes roughly $32,000. That's real growth. That's nothing to ignore. Now take that same $10,000 and invest it in a simple, boring, low-cost index fund that tracks the S&P 500, which has returned an average of about 10% annually over the last century, closer to 7% adjusted for inflation. At 7% real returns over 30 years, that $10,000 becomes roughly $76,000. At 10%, it's over $174,000. Same money, same time, completely different outcome. And I know what you're feeling right now, because I've talked to a lot of people about this, and the feeling is almost always the same. It's not excitement. It's this quiet, sinking realization of, oh, I've been doing this wrong. And then almost immediately after that, it's resistance. Because the gap between what you've been doing and what you could be doing is uncomfortable to look at directly. So most people look away. That's the real reason people don't invest. It's not a knowledge problem. It's a comfort problem. The savings account feels safe. Investing feels like gambling, and nobody wants to feel like they're gambling with money they worked hard to save. And look, if that's where your head went, I hear you. You're thinking, but I don't want to lose my savings. What if something happens? What if I need that money? That's not an irrational fear. That's actually the right instinct pointing at the wrong target. Because protecting your savings and investing your savings are not mutually exclusive. They're two different jobs for two different pools of money. And once you understand that distinction, the whole thing gets a lot less scary. You build a system where your money has a job, and every dollar is working where it's most effective. Which brings me to the framework. Step 1. Build your floor before you build your future. Before a single dollar gets invested, you need a cash buffer. Typically 3 to 6 months of living expenses sitting in a high-yield savings account. This is not your investment money. This is your financial immune system. It exists so that when life happens, a job loss, a car repair, a medical bill, you never have to sell an investment at the wrong time to cover it. Once that floor is built, everything above it has permission to work harder. Until then, getting that buffer in place is the most important financial move you can make. Step 2. Understand that investing is not the stock market. It's a spectrum. When most people hear investing, they picture someone staring at a screen watching red and green numbers flash. That's trading. Investing is slower, simpler, and, done correctly, largely boring. A low-cost index fund through a brokerage account or a Roth IRA is investing. Buying an I bond is investing. Even paying down high-interest debt early is a guaranteed, risk-free return. The spectrum is wide. You don't have to start at the scary end. Step 3. Open the account before you're ready. This one sounds almost too simple, and that's exactly why it works. The single biggest barrier most people face is inertia. The research, the overthinking, the "I'll do it when I know more" loop. It's a trap. You do not need to understand the market to open a Roth IRA. You need 15 minutes and a social security number. The act of opening the account changes your identity from someone who might invest someday to someone who invests. That shift matters more than most people realize. Step 4. Automate the transfer so willpower is never in the equation. Every personal finance system that actually works over a long period of time removes the need for repeated decisions. Because willpower is finite, motivation is unreliable. You set up an automatic transfer, even $50 or $100 a month, from your checking account to your investment account on the same day your paycheck lands. And suddenly, you are investing by default, not by discipline. And over 10 years, you have an account you barely noticed building. Step 5. Increase your contribution every time your income increases. This is the lever that most people overlook. When you get a raise, when you pay off a debt, when you pick up a side project, a portion of that new cash flow should go directly to your investment account before your lifestyle absorbs it. Personal finance researchers call this saving the raise. The behavior is simple. You lived on what you had before the raise. You keep living on that. The difference goes to work. I want to use an image here that's helped a lot of people I've talked to really feel this, not just understand it intellectually. Think about a jar of seeds. If you keep those seeds in the jar, sealed, safe, on a shelf, they are preserved. Nothing happens to them. They don't rot, but they also don't grow. Now take those same seeds and put them in soil. With water and time, each seed becomes something that produces more seeds. The jar gets fuller not because you kept adding to it, but because the original seeds did work on their own. Your savings account is the jar. It preserves. It's sealed. It's safe. Investing is the soil. It's messier. There are bugs in soil. There are bad seasons. But over a long enough horizon, the things you plant in soil do something the things in the jar can never do. Now, what if the market crashes? What if you invest $5,000 in January and by March it's worth $3,800? What then? Here's the counterintuitive truth. If you're in your 20s or 30s, a market crash in the short term is not your enemy. It's a clearance sale on future wealth. When the market drops, every dollar you invest buys more shares of the same assets. More shares means more growth when the market recovers, and historically, it always has. The people who got hurt in 2008 were not the people who stayed invested. They were the people who panicked and sold at the bottom, locking in their losses and missing the recovery. Time in the market, not timing the market, is the variable that actually matters. Risk in investing is not whether the number goes down temporarily. Risk is whether you need the money before it has time to recover. That's why the emergency fund comes first. That's why you don't invest money you'll need in the next 1 to 3 years. Build your floor, plant your seeds, and let time do the work. So let's make sure you're leaving with a clear picture of exactly what to do. Step 1. Build your floor. 3 to 6 months of expenses in a high-yield savings account before anything else. Step 2. Understand that investing is a spectrum. Index funds, Roth IRAs, paying off high-interest debt are all investing. Step 3. Open the account before you feel ready, because readiness is a feeling, not a fact, and it will never fully arrive. Step 4. Automate the transfer. Remove willpower from the equation entirely and invest by default. Step 5. Increase your contribution every time your income increases. Save the raise before your lifestyle can spend it. 5 steps. No jargon, no market timing, no secret knowledge. Just a system that works because it's built for real human behavior, not for the version of yourself you think you should be. The gap between saving and investing is not a knowledge gap, it's a decision. And now you have what you need to make it. One question for the comments. Right now, are you mostly saving or are you actively investing? No judgment either way. I want to know where you're starting from. And if you're on the saving side, tell me what's been holding you back. Let's talk about it down there. If this video helped you see your money differently, share it with someone who's got a savings account and hasn't made the move yet. That might be the most useful thing you do for them this year. Like and subscribe if you want more of this. I break down money concepts like this every week in plain English. No fluff, no filler. Your investments can grow your wealth, but your income is what fuels those investments in the first place. And right now, AI is changing the future of work faster than most people realize. Click the video on your screen to learn why Americans are replacing jobs with AI and what you can do to stay ahead instead of getting left behind. I'll see you in the next video.